You don't need $10,000 to start investing. You don't need to understand the stock market. You don't even need to know what a ticker symbol is. Most people delay investing for years, sometimes decades, simply because they think they need to master absolutely everything before making a single move.
And honestly, delaying like that because you think you need a massive pile of cash, like 10 grand, is probably the most expensive mistake you will ever make in your financial life.
The reality is radically different. By the end of this explainer, you are going to know exactly how to start investing with just $50. No crazy jargon, no complicated math, just a clear, simple path forward. Okay, let's dive into this. Here is our completely jargon-free playbook for today. We'll be looking at why investing beats saving, building a safety net first, the basic investment blocks, consistency over market timing, and finally, how to automate for long-term growth. All right, part 1, why investing beats saving, beating inflation. So when your money is just sitting around in a regular savings account, it's actually slowly losing value to inflation over time. Prices go up, but your cash, it stays exactly the same. Investing, on the other hand, gives your money the chance to grow faster than inflation. And it does this through the absolute magic of compound returns, which really just means your returns start generating their own returns. People often think that choosing not to invest is playing it safe. But here's the thing, the biggest risk isn't actually investing and losing money. It's not investing and guaranteeing an invisible loss of your purchasing power every single year without even noticing it. It's a silent drain on your hard work. Moving right along to section 2, build a safety net first, emergency funds first. Before you jump into the market with a single dollar, pretty much all financial guidance agrees on one thing. You need to set some cash aside for emergencies. And look, this isn't about being overly cautious or paranoid. It's highly strategic. Having a cash safety net ensures that when your car breaks down or a surprise bill pops up, you are never forced to sell your investments at a really bad time, potentially at a loss, just to cover those expenses. It completely protects your growing wealth. Okay, part 3, the basic investment blocks, stocks, bonds, and funds. You really don't need to be a financial expert here. You just need to understand the basic blocks. The first one is stocks. In the simplest terms possible, when you buy a stock, you're literally just buying a tiny slice of a real, actual company. The second block is bonds. Think of these as loans. You loan your money out, and in exchange, they pay you regular interest. It's generally a bit steadier and more predictable. And the third block, which is a massive one for beginners, is index funds. This is a super simple way to own a tiny slice of hundreds or even thousands of companies all at once in a single package. It is the ultimate tool to instantly spread out your risk through diversification. Section 4, consistency over market timing. Don't time the market. Now this right here is the single decision that matters way more than picking the perfect investment, and it's something most beginners get completely backwards. See, a lot of beginners waste months or even years trying to find the absolute perfect moment to start investing. But historically, investing a fixed amount regularly over time, a strategy called dollar cost averaging, almost always beats keeping your cash on the sidelines while you try to perfectly time the market. I absolutely love this quote because it hits the nail on the head. Waiting for the right time to invest is often just fear wearing a strategic disguise. Here is the huge takeaway for today. Time in the market matters so much more than timing the market. Section 5, automate for long-term growth. Set it and forget it. As you start looking into those broad, diversified options we talked about, I have to warn you about something that seems completely harmless. Fees, specifically a 1% fee. To a beginner, a 1% difference sounds incredibly tiny, right? I mean, almost negligible. Well, because of how compounding works, over a 30-year period, that tiny 1% fee can quietly siphon off tens of thousands of dollars in lost growth. That is staggering. It's exactly why choosing low-cost index funds is so vital to actually keeping the wealth you build. So how do we put all this on autopilot? It's beautifully simple. Step 1, set a fixed amount you can afford, even if it's just that $50. Step 2, schedule it to automatically transfer and invest regularly. Step 3, just let the background system run. By automating this whole process, you remove human emotion, you kill procrastination, and you don't even have to wake up feeling motivated to invest. It just happens.
And that, my friends, is the whole secret to beginner investing. You don't need to be a genius. You don't need to pick the next big breakout stock. You just need to start small, start right now, stay consistent, and let time do the heavy lifting for you.
Real quick, before we finish up, I do want to note that this explainer is for general educational purposes to help build your foundational knowledge. It definitely shouldn't be taken as personalized financial advice since everyone's situation is completely unique. Which leaves me with a question for you. Where are you at right now? Have you not started yet, or are you already investing? Jump down and let me know your stage in the comments. And hey, if you want a part 2 explaining exactly how to open that very first account step by step, hit like and make sure you're subscribed so you don't miss it. Start small, start today, and I'll see you in the next explainer.